If you're investing, I'd say let's take a 3-year cycle. You're investing say you're investing in seed. By that point, we should see some of those early investments either have a markup or, from a performance perspective, a meaningful level of growth. And now, look, if it's going to differ by sector and by
right, how deep tech it is and all that stuff. Is it biotech? That's different.
Yeah, I think you can put a marker in each of those to say, like, okay, this is what I think is going to be most interesting versus not. This is going to be most compelling or not. And then, the markups I do take with a grain of salt, right? Unrealized marks are what they are. If it can be validated through, a new financing round and then the look through into fundamental performance that's growing, that's where I think you start to feel comfortable that.
Hey everyone, welcome back to the Ignite podcast. Today, we're delighted to have Matt Curtolo on the program. He's an experienced LP and allocator with over 20 years in private markets. He's managed investments for leading institutions, including Halligan, MetLife. He's built an investment program from the ground up at a fintech startup called Allocate. He holds several advisory positions that span startups, asset management firms, fund of funds. He's also run an advisory practice, providing GPs with strategic guidance on LP management, investor relations, as well as fund and firm building. Wow, just so much really cool stuff to talk about. Welcome to the program, Matt.
Thank you, Brian. Great to be here.
I'd love to kind of start at the beginning. Like, how did you find your life in private markets? What does that origin story look like?
It's funny because when I think back, everything looks more clear in reverse than it does while it's happening. I graduated undergrad in 2004 with a finance degree from a small college in Pennsylvania. Honestly, wasn't sure what I wanted to do. So I'd say it was serendipity in terms of how I found my first role in private markets. A firm called Hamilton Lane that most folks know in this space now, a publicly listed alternative asset advisory firm at the time, now asset manager. They were hiring a role in the back office. So I just, it was interesting to me to kind of get to learn something new that I didn't have a ton of exposure to, working with alternative assets. And that was
what is the back office for anybody listening to this and know finance like we do? Because I'm also a finance undergrad 2003, so we have that in common.
Yeah, absolutely.
Almost the same year.
The back office aspect at the time, and I hope we get to talk about technology and alternatives, but we were processing capital accounts, financial statements, any of the underlying funds for any of our clients. We were taking the physical documents and keying them into a system. So it was effectively a data entry role. You needed a little bit more acumen to be able to understand what to put where, but we were directing cash flows and things like that. So it really was the nuts and bolts of how the funds work.
Yeah, I love this analogy. And if you ever watch the show Mad Men and you see like all the desks, somebody told me that the way to think about all those people on that floor with all those desks is each one of them is a cell in a spreadsheet. And they're doing some sort of calculation. Something comes onto their desk and they have to tabulate some stuff using mechanical calculators and then kind of move it to the next desk.
It's a very fair comparison. And I think it wasn't that long ago. I mean, I had a full head of hair back then, but it was definitely a different time where the amount of information that we were processing was really done by hand. And now when I think about where we are today, a lot of those processes have been, I wouldn't say totally automated, but definitely enhanced from efficiency perspective.
Yeah.
I was fortunate to get that role. And honestly, the timing couldn't have been better from a firm perspective because in early 2005, mid 2005, Hamilton Lane really started to experience a big growth in terms of the advisory clients that they worked with, as well as the business as a whole. So I got the opportunity over the subsequent 7 years to get involved with a lot of new initiatives, to help work with clients on the very front end, working with big sovereign wealth funds, public pensions, endowments and foundations, international clients, work in our research group, work with our secondary investment fund, just really across a lot of different areas. And it felt, even though it was a mature company at the time, really fast-paced like a startup in retrospect. So I was really fortunate to find that.
Yeah. And then tell me the story of how you got into alts.
Yeah, that business was effectively, the core business was alternative investments. So the back office was processing financial statements and capital calls for clients who had exposure to alternatives. So that was, the business was focused around it. I can't say I knew a whole lot about it when I started, but that piqued my interest, being able to see the numbers on the page and the names and get to understand a little bit more. And through osmosis and opportunity, I was able to kind of move into more active roles.
Yeah. So what was the next role after that? So you're back there calculating cash flows and capital calls. And what did you get interested in next?
The transition was, given there were a lot of new clients coming on board, the opportunity became, we needed a front end service person to work with those clients effectively, be able to be the first line of defense, working with the institutional clients on what is in their portfolio, how they're getting reports on a quarterly basis, helping produce those, putting in a lot of detail around, or qualitative detail around, what companies drove that performance, what things they should look out for, helping them do strategic planning. So that was the next role I got involved in. And it was a really nice, I call it a hybrid role. It wasn't doing the actual investment work, but it was really getting some depth in terms of understanding why we were recommending a certain fund to a certain client. So mapping that whole journey from a prospective fund, recommended fund, client portfolio plan to ultimately into their portfolio. And so I got to touch all parts of that and then work with some of the higher profile clients we had.
Any memorable stories from that kind of era? Any big takeaways and lessons?
Yeah, I mean that point in time, let's see, that would have been, call it '05 to '09 when I was primarily in that function. And that was really the dawn of the information age. So I'd onboarded a ton of new clients. So finding the appetite and the availability, or I'd say the availability of the data and then the appetite to consume it on the other side. Two colleagues of mine and I sat in what was a converted file room, which actually did store a ton of these actual paper documents that we were processing and working through and keeping in there. It was affectionately known as the frat house because it was three guys in our mid-20s at the time.
Right. Yeah. What happens in the frat house stays in the frat house.
Yes. Honestly, Brian, from there, it was the company started a dedicated secondary fund practice. So we're always doing secondary investments, but the fund practice formally launched in the latter part of the 2000s, right around the global financial crisis. So it was opportune time for me. I felt like it would be an interesting place to learn both the fundamental aspect of underwriting a company, but then also understanding the qualitative pieces of a manager. So that was a great mix between the two. And then ultimately, in 2011, ended up moving on from Hamilton Lane into a OCIO called Hurdle Callahan that you mentioned before.
What is OCIO? What does that mean?
Yeah, OCIO is an outsourced chief investment officer. So think of that model as most of the clients we worked with there were either individuals, high net worth individuals, or family offices. So folks with, let's call it anywhere from $5 million of wealth, investable wealth and above, as well as smaller institutions. And those institutions could be a community foundation, a hospital. We always used to say a lot of them were good works organizations. So that was the function being they would outsource the entirety of their investment office. The name, it's not just a clever name. It really was the function that we were taking on. Everything from the back office, which we just talked about, managing the portfolio. And this was beyond alternatives. This was everything within their portfolio, public investments and beyond. And we would do the investment work, provide them access to what we did in private equity was a pooled vehicle. We'd have direct services around other things in their portfolio, helping them plan and monitor and things like that. So generally worked for firms that were, or for investors that were smaller in size, that didn't have an internal staff. So they always say with the outsourced model, if you continue to grow, you generally outgrow that because then you're going to hire a CIO internally. You're going to hire maybe more investment staff. But for us, we were helping these groups really get the benefit of scale and act as groups that could do the same thing that a big institution could.
Like a multifamily office, right?
Yeah, exactly.
Yeah.
The services that we were able to provide, and honestly, on the private market side, it was more of a scale and access play. So maybe these institutions on average had $50 million of assets. They wanted to make $1,000 investment into a fund. Well, that's not possible independently, but pooling all those assets allowed us to have the buying power to be able to get into a fund with much higher minimums. So provide that flow through access to those underlying clients.
Right. Yeah. So almost like behaving like a fund of funds in that case, because a lot of the big name funds will have, 25 million or 10 million mins.
Exactly.
Right?
Yeah, that was the story. And frankly, a big part of the value proposition was getting into things that otherwise wouldn't be available.
Yeah. And what is it about that's appealing as an LP, as someone who is advising these kind of smaller, 5 to 50 million AUM assets? Is it the kind of the flight to quality? They kind of see that as like, oh, I'm in the Sequoia fund or whatever it is.
Yeah, to some degree, I think it revolves around perception, right? A lot of people think I'm not invited to this party. I really want to go there. And that's some of the cachet that comes with a lot of the brand name firms. There just wasn't an avenue for groups like of this size to be able to enter. I would say the other piece is many of the investments that they were seeing directly were maybe not of the same quality. And that may be just a function of where they were located geographically or the experience and the networks of the people on their board or on their team. They could see very high quality things, but still not be able to get into them. So for the
Right.
LPs, they were getting, I will call a professional eye on the diligence process and the sourcing.
Right.
And honestly, the flip side, the GPs really found that appealing. They got to deal with one investor. They would interface with me, and I
Right.
would be a representative of. I think at a time we had 150 or 200 different LPs in our funds. Benefit of
Yeah.
scale for sure.
Yeah, the benefit of scale, so you can get into the in-demand things. And how did you advise them on asset allocation? Right, all these different LPs have different needs, right? Some
Yeah,
have high cash flow needs, some of are very long-term growth focused. And how
yeah,
did you how much did you weight them in the alternatives? You came from alternatives, and
mhm,
I think
yeah.
we've seen a trend towards that, especially with big endowments overweighting in alts.
At the time, a lot of people thought about illiquidity. What do you say? Illiquidity as a feature or a bug. A lot of people thought of it as a bug, and oh gosh, we can't have all our money tied up. What if we need it? So people instinctively started their range at zero. And for most clients, it was a single digit percentage of their total asset allocation to go to broad alternatives. And then that would be segmented across venture growth, buyouts, debt, real estate, sort of any alternative asset. So their look through exposure was pretty low, mostly based on the old model of we need more liquidity. In reality, we had great people on staff who would look at the liquidity needs of most of the institutions. It's like you have way more liquidity than you need. Try to take advantage of the arbitrage in terms of being able to generate higher returns, locking up the capital. So we tried to flip the script and say, start at 100. Like if you could be 100% illiquid, that's great. You're going to get
Yeah,
the
you're
best
gonna get the best
outcome.
returns.
Yeah, based on a model, right? There's a lot of variables
Yeah,
still
based on
embedded
the
in that.
averages, asset
Yeah,
class averages,
exactly.
things like that. Yeah,
So getting people to work backwards from 100 rather than up from zero
I
was
like
an
that.
interesting way to think about it for folks. Which I think over the 8 or 9 years I was there ended up moving folks from that single digit percentage to maybe into the teens.
Interesting. And
Yeah,
you can also stagger your alternatives, I would imagine, as well, right? You don't
very
want to go
much.
from year zero and then go into a bunch of 10-year funds, and then you're just locked up for 10 years
It's
on all
a
your assets. Yeah.
a big piece of it for most clients was the how do I get there? And so we did a lot around modeling of cash flows, not just from the alternatives portfolio, but from the overall. So you would think, okay, I want to get to a target of 10%. I'm starting at zero. To your point, we just said you don't want to do all that tomorrow. You want to do
Yeah.
that over time, both from a vintage year diversification perspective. The market's going to be very different at different points in time, but
Right.
also you can have the opportunity on an annual or semi-annual or biannual basis to quote unquote rebalance your alternatives allocation if other things happened in your portfolio.
Yeah. It's an interesting matching process being in the middle there, between people with money and people investing the money. It's got to be a pretty hard place to be.
It is. It's one of those things where it's a service you're providing, right? The capital is flowing through the channels that would traditionally flow through, right, into the funds, whether that be through banks or intermediaries or direct. But in our case, we felt like there was, and it's not just it's Hamilton Lane, it's a Hurdle Callahan, it's any of the wealth managers today that are becoming more active, protecting people from themselves. You're giving them access to things that they wouldn't have otherwise, but you're also trying to fit a lot of different needs on both sides. So
Right.
there's a lot more art to it than just plug a number into a model and have it spit out the right allocation. There's a lot more that goes into it.
Yeah. So tell us about the kind of the rest of that tenure. I mean, how did that
Yeah.
come to an end? What did you do next?
Admittedly, I think that was a great stretch where I ultimately ended up running the private equity program within Hurdle Callahan. We had grown that to a really great point. But I had an opportunity to move on to an institution a little bit larger where I'd never really worked in a place where I had no external clients. So I went to work for MetLife. So working inside the alternatives group for the insurance company, managing effectively the general account for the insurance company and
Right.
its affiliates. So no need to sell a fund, fundraise, worry about investor relations, things like that. I thought it would be great experience also
Yeah.
working at an institution of that size and stature.
Yeah. And they
So,
have how many assets under management are they managing at MetLife?
yeah,
Or is that public? Yeah.
I think it's publicly available. I think we used to quote something in the $600-700 billion
Wow.
range in that general account.
Wow.
So it is publicly available as a listed entity. But
Yeah.
I think the underlying piece that we were managing, if you think of an insurance company, not dissimilar to a pension fund, there's assets and liabilities that have to get matched, right? You have
Yeah.
payouts, you have the actuarial tables as a life insurer of what you're going to need
Right.
at what point in
Yeah. You
time.
kind of know like when people are going to die.
Exactly. Yeah.
statistically, and so you kind of know what the premiums are,
Right.
and so you
So
know how
you're
like your investment horizon and when you need the money.
exactly. And you know what kind of returns you need to generate to fulfill those needs. So a very large portion of most life insurers' book is in fixed income, real estate, is in yield generating assets that are more safe than I would say not. The portion of the portfolio we manage an alternatives book, which given the rest of the portfolio was in those yielding assets, it was
Yeah.
mostly equities. It was mostly venture growth and buyouts. And
Okay.
that was a very small piece of what was a very large pie. So even though within the context of the organization, equity exposure was fairly low in the single digit percentages,
Yeah.
it was tens of billions of dollars that we
Right.
were managing on behalf of the insurance company. So it was a interesting dynamic there. And I always joke about it. I didn't have to explain who MetLife was when I would call a GP. So it was
Right.
very easy to
Hey, I
kind of go in
represent
there.
MetLife. You want to take the call? Yeah, of course.
Exactly. So it opens a lot of doors, and there's something to be said about the brand recognition.
Yeah.
And there's also 30 years of alternatives portfolio history. So the company started investing in the 80s, so had longstanding relationships with some of the best firms in the world. It's, you're going into a mature portfolio of high quality assets. We had a team of a dozen globally. So we were both looking after a very mature portfolio, but also thinking of ways to enhance that in the future.
Differ from what you were doing for those 9 years at Callahan.
Yeah, I think the experience of working with 200 LPs in a fund of funds context, which I was doing at Hurl Callahan, versus what we were doing at MetLife, managing a single portfolio, single decision. I think that makes it, the investment decision making was, we're writing a check in both places, but the needs of both firms was a little bit different in terms of what we were trying to accomplish. Having to report out, I had a lot of conversations with clients during my time at Hurdle where it was explain what happened in the quarter, work with all these underlying clients. So it was a much more commercially oriented role leading that fund. And, with our team that we had at the time, spending a lot of time with clients and the internal advisors.
Yeah.
Where at
A lot
MetLife,
of
it was
managing
much
emotion,
more.
I would imagine, too, right? With all these clients. I mean, they all have differing opinions on things and emotions and needs. When you go to MetLife, it's one thing. It's like, we want to maximize returns over these different investment horizons, 1 to 3 years, 4 to 6, and so on.
Exactly. The goals are very clear and you can execute against those where you hit the nail on the head. There's an element of understanding each of those clients. And fortunately, each client had a dedicated relationship manager as the person leading the private equity efforts. I wouldn't be dealing with that client on a day-to-day basis. So it was more subject matter expertise that was coming in from time to time. But still, you have to deal with a lot of different aspects of the business.
So what happened next? So MetLife, and then
Yeah, in retrospect, I say this was the pendulum where I went from Hamilton Lane that was smallish and got bigger, went downstream to Hurdle Callahan that was sort of around a smaller size, went big again with MetLife, and then I decided to move to a startup. So I went all the way to the other end of
wow.
the spectrum. So I got introduced to the founders of a company called Allocate back in the middle of 2021. The mission of Allocate was really to build the digital infrastructure and plumbing to serve what I'll call institutional retail clients, ultra high net worth family offices and wealth managers, and give them access to a portfolio of highly vetted and curated venture capital funds.
Interesting.
There are other platforms that exist. You can think of things like iCapital or Case on the larger, more institutional end, or you could think about an angel list where an individual investor can participate in and write smaller checks into companies and funds.
Allocate
But
is almost like angel list for higher net worth, qualified purchaser, family office types that have
it,
tens of millions of assets under management. It's a much bigger check than angels on angel list, right?
It can be, but it doesn't have to be. So I think the idea was it could service everyone from the folks who were already participating on other platforms as a qualified purchaser, but then also be able to provide the access to things. Thankfully, both our founder and my team on the investment side, we all had a lot of experience in relationships. So when you could go to a general partner and say, look, I can give you access to this huge community of high net worth individuals and folks that you'd love to reach, but
Yeah.
can't in an economic and efficient way. We
Right.
can pull all that together and provide that into your funds. Very few GPs were not interested in partnering with us, also knowing that that capital source was maybe small today, but growing in the future.
Yeah. I'd love to hear from a GP perspective. What's in
Yeah.
it for the GP to work with Allocate? And then on the other side, what's in it for these family offices, high net
Yeah.
worth QPs?
Yeah, it's funny because I think the value proposition, as we just talked about with Hurdle Callahan, is the value of pooling and scaling. So, in an individual basis, it may not be possible to write $100,000 check into a top tier firm, into a
Right.
Kleiner Perkins or a Lightspeed
No,
or
by the
an
time you get
ASIC.
to like fund, by the time you get to like $100 million fund, you're not taking 100K checks.
Right, it's very
Right.
hard. So
It's
those
very hard.
folks,
It's hard to move the needle unless they're like a friend or something, or
yeah,
they've been backing you for years. They all let you in for the 100K. But like
yeah,
really, I mean, these private funds, the mechanics are you can't have more than 99 accredited investors. And I forget what the QP limit is, but
it's a higher threshold for the QP, but it's also a higher income and net worth threshold. So that's
right.
where you start running into the challenge. But the
But there's
qualified
also look
purchasers,
through rules, I think, too, right? So
there
like if you
are.
have like, I don't know, if you write a check to my fund and there's 50 QPs, like the SEC wants to know that. They want to know the look through on that entity and the KYC and the AML. They want to know all the
Absolutely.
underlying individuals, basically, entities.
Yeah, you have to manage your LP base, the scale that you want to get to. So for us, we worked with QPs. We worked at pooling them together into whether it be feeder funds or fund of funds or customized structures. So basically, giving them the control of. We would do the underwriting of the managers the same way we would do in an institutional context and offer those up to clients in whatever format made the most sense, both for them and for the GP. So that was from the question you asked on what's the benefit to the GP. They get access to a new form of capital without having to go directly to them. And the LP's benefit is they're getting access to something they wouldn't have the ability to
Yeah. So you guys are
source
almost
diligence.
behaving as a fund of funds, but almost like a technology driven fund of funds.
It's a good way to put it. I think that the fund of funds from a product perspective is one of the things that would be offered, but for the opportunity to go directly into a fund through a feeder vehicle, which I
Yeah.
think it's a newer phenomenon,
It's
but I
almost
think
like
that's coming.
a syndicate process, maybe
Yeah,
how I might describe it. It's like, hey, I have an allocation in this really in demand $150 million fund. I have 1 million or 5 million, whatever it is. And now you go back to your LPs. Who wants in? It's like almost the same thing I would do on an individual syndicate deal.
it is. I would say it's a little more structured than that
Yeah.
with clients. Some clients would have specific mandates. We would decide, okay, we're going to put this in our discretionary fund of funds vehicle that
Hmm.
has raised money on that basis. Or if the allocation is sufficient, we might put it into, we might make it available through a feeder where folks can just kind of opt in syndicate style.
Right. Yeah,
Yeah.
that's really interesting. That's a
It,
really interesting model. So how do you guys make money?
yeah, so the LPs pay a management fee on the vehicles that they invest in, which is I'd say slightly dissimilar, where the GP is on the platform at no cost to them, other
Right.
than I used to say, other than the unfortunate part of having to work with me for 10 plus years. But no,
Having to talk to Matt.
it's a high
Any
tax.
GPs listening, Matt's pretty cool so far, so you should definitely take his call.
Yes, it goes back to the supply point of like what GP would we obviously have to go through the diligence
Yeah.
process. It has to meet
Right.
a threshold, but what GP wouldn't want the opportunity to have eyeballs on you through a vehicle that makes sense?
Investing and raising money are both really, really hard. But fundraising is always the kind of the long pole as you're getting started. What are some of the things that you look for emerging managers like myself?
Mhm.
That's a big part of the audience. Most of my friends are emerging managers.
Yeah,
Not to mention all the founders that listen and stuff like that. But as you kind of look for what are those some of those minimum bars? You have so much experience in alternatives.
it's funny you say that, Brian, because right now one of the hats that I wear in my consulting business is advising emerging managers on how to go to market and how to position. So
Yeah.
I spend a lot of time thinking about this. And emerging managers, it's a broad term, but one, you're oftentimes without a track record, so you
Right.
can't.
Well, let's define what an emerging manager is.
Yeah,
So, like limited track record, AUM under 150 million is what I've heard. Is there anything else that you kind of would define?
it's. I think there's the broad terms. It's like funds 1 through 3 can fall into that bucket. It can be fund sizes under 100 million. So whether that be you've raised 2 funds already, and fund 3 is a $75 million fund, that might still fall in the category. Others might think of emerging as not necessarily the fund size, but the GP experience. So maybe it's just a brand new, maybe it's an ex-operator who has a great track record and is going to raise 3, 4, $500 million. So I'd say some of those categories are a little bit more flexible. I think
Yeah.
of it as the fund number or the tenure of the fund. say less than 3 funds under your belt and maybe less than 7 years of experience.
What if you have different strategies? So you have like a seed strategy, and then you have like a growth strategy, and you have like an impact strategy, and you have 3 different funds. So, and they're all, and maybe one of them's on fund 2, or 2 of them are on fund 2, and like one's on fund 1. How does that calculation work for you?
It's kind of splicing that up between emerging fund and emerging manager.
Yeah.
Right. If let's say the impact strategy in this context is following a consistent framework led by the same team that's working on the other stuff, I would look at that as maybe an emerging fund, not an emerging manager. But if it's, a new team that's set up under the same infrastructure to lead a strategy that's a little bit different than what the firm's already doing, you could probably pull that under emerging manager. I think if you're an LP with an emerging manager portfolio or an emerging program, you could look at either of those as potentially fitting in.
So how do you evaluate these sub 100, 150 million first 3 fund managers? Maybe they're coming to you at fund 2 and they're like, hey, look at my TVPI on fund 1. What does that look like? What's good look like for early stage or growth stage? How does that differ? All that stuff.
Yeah. Performance is generally, I'm not going to say it's the last thing you look for. It's something that's difficult to demonstrate at a fund 1, fund 2, or even a fund 3. The way I think about it, fund 1, you're buying the story, right? It's going to be you as a GP. Why are you uniquely qualified, or why are you different from the offerings that are available in the market? Why is there a reason for you to exist? And then does your strategy, this concept of GP thesis fit, does your strategy match your background and skill set? And there's an overlay of time. Like, is this the right moment where we think that fund can be viable? So think of those 2 as kind of the overarching. I'm buying you, the GP, and the story you're telling me around why you can execute the strategy that you've determined is what you want to go to market with. Everything else is a little bit more double clicking into each of those. But what I would say is, as an emerging manager, making sure that you're doing something that is different than what's in the market, looking at emerging fund managers day after day. Everybody says they're unique, and I can tell them that on that very day, I've looked at 2 or 3 opportunities that look very similar.
Almost the same. Yeah.
Yeah. So there's an element of self-awareness, but really there's this phrase one manager told me is like, go with your gifts, right? Whatever you are, whatever you're good at, be authentically you and kind of lean into that. In a lot of cases, it doesn't have to be different. It doesn't have to be contrarian. It just has to be strong enough and authentic to who you are that I, as an LP, can look at that and say, I believe you're qualified and able to deliver on the outcome that I think that you're putting forth.
I love that. And it's something some other LPs on the pod have echoed, which is like, you're really underwriting the person, the GP or the partners, right?
Very, very much. Yeah. Especially at a fund 1, Brian, because I think as you get a little bit more mature, so fund 1 is the story. If I buy the story, and I should preface it with everything I see is a no at the start. It's a default no. So I wrote a little piece about it, but
I love that.
It's really hard to get out of that phase, right? You're going to say no, same way you would be looking at companies for the portfolio and founders. Yeah. Your bias is to be skeptical and to say no. But once you get through the process to a yes, my inclination is, so long as you don't change your stripes, so long as you're the same person executing the same strategy, and at a point I can start to see performance, I should have no reason to leave and not invest in you in the future. Things can happen, but I flip from a default no to a default yes. Right. So I've gotten to that point.
So you invested fund 1, let's say you underwrote the GP, they spun out of another fund, or they're the amazing exec from Uber or whatever. And so now they're going to go invest. You bought into the story, you got to a yes. So now you're evaluating them for fund 2. So it's a default yes now. And now you're looking for no's. What are you looking for in that fund? One that occurred over those, like, let's call it a 3-year deployment period.
I'd say from fund 1 to fund 2, it's the story, and then did you do what you said you were going to do, right? Because I still don't have enough information to assess your performance on like how well you were able to do it.
Yeah, you said you're going to do seed and lead checks, you didn't do that.
Yeah,
or you said you were going to follow and you didn't do that.
Right, and it doesn't disqualify you. It just means you have to explain why you didn't. And
why'd you change your mind? Yeah,
exactly. And the beauty of that is hopefully along the way, the good managers will communicate, okay, look, we were going to do, these 3 sectors, this one, just not something we want to focus on anymore. So we're going to discontinue it.
Yeah.
Don't let me come to the fundraise for fund 2 and see this allocation for 30% of your portfolio is 0. So the transparency and communication along the way is important, but that fund two diligence is really focused on, did you do what you said you were going to do? Is there enough traction that I can see the green shoots of what
Yeah.
those companies could be?
What does good traction, moderate traction, and poor traction look like
Yeah.
for a particular early stage? Because that's our lens at Ignite.
Yeah.
Yeah.
If you're investing, I'd say let's take a 3-year cycle. You're investing let's say you're investing in seed. By that point, we should see some of those early investments either have a markup or, from a performance perspective, a meaningful level of growth. And now,
Right.
look, if it's going to differ by sector and by
Right. How
by
deep tech it
market,
is and all that
right?
stuff.
Yeah,
Is it biotech? That's different. Yeah.
yeah. I think you can put a marker in each of those to say, like, okay, this is what I think is going to be most interesting versus not. So, or I'm sorry, this is going to be most compelling or not. And then, the markups I do take with a grain of salt, right? Unrealized marks are what they are, but if it can be validated through new financing round and then the look through into fundamental performance that's growing, that's where I think you start to feel comfortable that, hey, I think Brian knows what he's doing now. And as I'm underwriting fund two, he wants to execute the same strategy. Maybe wants to raise a little more money to put behind these companies to follow on. Maybe added another partner who's going to complement him in a certain way, whatever it might be. As long as the story continues to check out, then there should be a continuity from the LP's perspective. I
Right.
always think underwriting a fund two or a fund two is a given so long as it doesn't blow up.
Yeah. So what about a fund one you missed for whatever reason? It was too
Yep.
small, whatever, and now it comes across your desk and you didn't invest fund one.
Yeah.
How are you underwriting it now that it's a new manager to you
Mm-hmm.
and a new fund? Yeah.
Yeah, it's the default no. It starts as a no, but you're taking that lens. You don't have the benefit of saying, what did you tell me in fund one? And what have I seen you do over the course of the investment period and the cycle before you've come back to market? So it
Yeah.
requires that depth of diligence that you have to go in and understand the GP thesis fit, the market cycle, the timing, the expertise of the managers. You have the benefit of a portfolio now that's been constructed. So I can ask more pointed questions about why you chose this, or why did you pay this for company X, and why portfolio construction, why did you write such a small check into this company? So I have a little bit more of the show not tell part of it.
Yeah. Yeah.
Right. You can have this strategy in action. So once I get comfortable with that, then you still have all the basic components of your diligence process, but that's the way I differ of two and a one.
Nice. And let's take fund three as well. So
Yeah.
now it's you got a lot of history now. You probably have 5, 6, 7 years of fund history to look at. And let's take those two scenarios: new manager, new fund, and existing manager. You invested the last two funds.
Yep. Let's take the existing manager because I think it follows the same framework of default. Yes, you're still doing the same thing you've been doing. Now I have the overlay of, by this point, let's say it's year 6, year 7. Some of these companies have hopefully reached a point where there's escape velocity. We can see if they're going to be outlier outcomes. If they're not, maybe there's been a sale, maybe there's some DPI along the way. I think too many people focus at the very earliest stages of a fund on DPI, but I'm looking for a lot more data points in terms of where this company where the underlying portfolio from fund one has gone. So that data, the performance, this is the first time performance at a fund level and a company level really starts to hold a more meaningful part of the underwrite.
Yeah.
Then you have the fund two portfolio. Again, we're looking at consistency of the story. Did you do what you said you were going to do as an existing investor? And then, now I start to think about fund three. What lessons did you learn? There's inevitably going to be some holes in that portfolio. If not, then we're just the best picker in the world. And I'm
Do you
probably
like to kind of
fighting
see
for
that on the
allocation.
deck? Do you actually like to see the kind of, here's our bad investments and here's what we learned from each of them? To just be like right tip of the spear at it and just put it right in the LP's face. Like, here are the 5 that we messed up on.
That's where LPs, for better or for worse, are going to want to spend more time. So you might as well nip that in the bud with a slide that outlines what you did, why you did it, and if you do it again, if you do an investment like that again, what's changed to validate that same thing's not going to happen.
Interesting.
So I think being transparent is, at least it's my opinion, that's going to be the selling feature for most of these groups. Don't make me ask the question. You know what the questions are, especially if I'm an existing investor. I hope we've had that conversation already. But if I'm a new investor for a fund three, there's enough history now where maybe you had a partner leave, maybe you had a couple companies go to zero. Maybe there was fraud in the portfolio, whatever there might be.
Right.
I want to know that as clearly as you can. Don't try to hide it or tell
Right.
me that it didn't happen, because the depth of
You're going to figure it out. Yeah.
the body of work too at this point, both from a reference call perspective, you have LPs from those first two funds. You have probably 20, 30, 40 founders that I can
Right.
reach out to and try to get the inside scoop on.
Get the back channel.
Yeah. So I think just as a GP, you're going to do yourself a favor by being upfront about that. Now, it shouldn't be slide 2 of like, hey, here are the things that we learned over the last two funds, but don't hide from it. Recognize that as an early stage manager, 60+% of your investments are probably going to return less than cost. Like it's the reality of it. It's not something to hide from. The benefit out of fund 3 is you've learned something from it and you've implemented in your strategy going forward.
I love that.
Mm-hmm.
We could dive into all these edge cases, funds 1, 2, and 3, but
absolutely,
for the sake of the audience, we won't go there. How do you see this democratization of venture capital happening right now? I mean, Allocate's AngelList, that was definitely kind of I think the first turn of it, but it seems like Allocate's trying to do it at a larger scale with the larger LPs.
Yeah. I mean, I think, like you said, it's already happening, but like, what are the best options right now? I think we're still in the learning phase of, one, how broad can this be, right? What's the investable, what's the universe? When you think about just the population in the US, the qualified purchaser community, that's a great place to start. But in a perfect world, the democratization can extend to more accredited investors. It can extend it. In my hope is we finally solve the ability for this to go into retirement accounts in a meaningful way.
Right.
So to
you
see
have the
this
Fidelity, asset allocation slider, and you're like, how much do I want to allocate to venture capital? You can just slide it over.
Exactly. Right. And I think that there's a lot that has to be worked around or worked through to get that in a place where it works. But that's true democratization in my sense.
Yeah.
Or in the sense that we think about this is a great economic opportunity. When you look at long-term returns, if you're doing this in a professional way, above median returns, and obviously top quartile returns are great, but above median returns are still going to generate really good alpha for the investor. So that's the way
and what are the median returns? I think I know the stats, but just for listeners out there in venture capital, private equity, and versus other asset classes.
Yeah, exactly. So if you look longer term, I don't have the numbers to hand, but think about the long-term venture capital top quartile return is probably in the low 20% range of IRR.
That's gross.
That would be net. I believe that comes from one of the net providers. And then I think as you go into private equity, you're probably into the high teens, maybe 18, 19%. You get up to that range on a top quartile basis, maybe into the low 20s. And then you think of some of the other alternatives like credit and real estate, and they have different components. But then the median, they're probably mid-teens. The challenge with venture is when you start getting into that bottom quartile, it's the biggest delta between top quartile and bottom quartile.
Yeah.
So manager
highest
selection
dispersion of any asset class is what I tell my LPs.
You do. The wild thing is if you just cut off the bottom half of the distribution and just say first or second quartile funds, if you look at venture, that number is dramatically above because both the top end is amplified and the bottom end doesn't drag as much. So where there's a tighter band of outcomes, you just expect that top 2 quartile number to be a little more modest. But with venture, so that's where I go back to the professionalization, the institutionalization of the diligence and manager selection. It's not a market where you'd want to buy all of it, right? You don't want, there's no functional way to do that either. But I do think where you can have somebody looking at that and hopefully avoid the pitfalls, avoid those bottom 2 quartiles, you can generate really good.
So you've been a strong advocate of remote work. Tell me.
Yeah, I admittedly, up until the pandemic, I had been an in-office guy for my whole career in finance roles. March 2020 was the first opportunity to really, under fire, test that out, really figure out. All of us had to, who were working in white collar jobs. You had the ability to be connected. We did work remotely from time to time before, but this was the first time to really be immersed in it. Personally, I found the flexibility of both the way I worked personally, but then the opportunity to not be bound by a physical location, to be able to do the things you needed to do. So embracing asynchronous work, thinking about how technology could not only replace our in-person interactions, but augment and make them even more rich.
Yeah.
So, all of those things. And starting in 2020, I have not gone back to a physical office since then. And I think
me neither.
I'd be curious, you too, Brian, but it's one of those things where you get a taste of it. And I think a lot of people, you see a ton of headlines around firms blowing the whistle to get people back into the office. It's hard to put the genie back in the bottle.
Yeah. And when COVID hit, I was already remote in Silicon Valley.
Mhm.
So I'm, working from my bedroom, because the houses are small because you're in Silicon Valley and real estate's expensive. And I'm like, why am I in Silicon Valley? And so we moved out into a remote part of Northern California. And I can't imagine going back in the office. I don't want to do that. Even if Team Ignite grows to be 100 people, which I don't want, by the way. But look, I wouldn't want us to have an office.
Yeah.
I'd want to be a remote first venture capital firm.
Yeah. And Brian, I think that's where I come back to too, is there are certain roles and certain functions that maybe are better suited in an in-person environment. But I also don't think it should be a remote only type of work. It's a remote first, but you do need in-person interaction, right?
Yeah.
To continue. I say it either fills the piggy bank up or replenishes the battery, because you're relying on trust in a lot of these situations when you can't see and talk to these folks in person every day.
Yeah.
But you build and develop that trust. I think it's one of those things people say about newer folks in the workforce. It's incumbent on the experienced people to set the culture that it's not about a place. It's about results. It's about productivity, and giving people enough latitude to see how they operate best, and then meet them where they're at in terms of bringing that in. This idea that physically going to location is going to guarantee or enhance productivity, when most of those places are not set up in any way to promote productivity. The cubicle farms, the buzzing noises, all the distractions, be hard pressed to see, other than an overhaul in some of these big office buildings, to really build places where folks can work better together.
Right.
I think it's going to be hard to at least make that argument and convince me.
We actually have a portfolio company, Team Out, that helps organizations, corporations plan team onsites, team
awesome.
offsite onsites. Yeah.
I love that. We need more of those, right? Because it's valuable, right? You're working with people. You don't want to feel like you're working with just machines.
You still want to get together. You just don't want to have to schlep it back and forth to the office 5 days a week. I think that's ridiculous. I think those days are over. Nobody wants that.
Yes. Virtual high five. That's awesome.
Yeah. Well, let's wrap it up with a quick rapid fire.
Yeah, let's do it.
What is your favorite book on investing?
I read a lot, but I think it's not even on investing, but it's How to Make Friends and Influence People.
Oh, yeah.
It's honestly been one of the books that I go back to, and it's such basic stuff, but it applies to investing and applies to everything. So
give people a fine reputation to live up to. I remember all those. Yeah, those are great. Who's been your biggest professional mentor?
Yeah, so I had a couple. My boss at Hurdle Callahan, I'll give him a shout out, was a guy by the name of Jamie Johnson. He was an industry professional, worked in a lot of different capacities, but he and I started not too far from a different point in time. So he took me under his wing a little bit and helped me understand both the organization and just being a professional. He was a consummate professional, and I learned a lot of the intangibles from him.
What's a trend in a PE VC that you think is overhyped?
I don't even know if it's overhyped, but you see so many of these opportunities to do these hyper late stage SPVs.
I have LPs reaching out to me like, "Hey, can I get some Anthropic?" And I'm like, "I don't know if you want to, man. You want to buy something at 4x revenue? Are you sure?
It's the chasing the shiny object too, and I think
it's so much.
That staying private for longer is definitely, I think, a good thing for these companies to be able to compound. But
if they were in the public, they get bashed. They'd be $500 million cap companies.
Right. So they're living in the place they need to. But I would say the number of those things I see, and the same ones that I see from different people, right? These are so heavily marketed.
Yeah, I see that as well. What's a trend in PE VC that you think is underrated?
I'll call it the boring, right? Some of the fundamental, I was just talking to a great manager focused on manufacturing, logistics, supply chain. And it's like, these are things.
They're kind of timeless.
They are timeless. That was exactly the word I was going to use. So those are things that just people don't.
You're always going to need more efficiency there. It's always going to be around. Mm-hmm. And we're just always going to need to make it better. That's the same way I invest. That's why I didn't do an AI fund when I started, even though I have an AI background, led the AI category AWS. I was like, oh man, we're in a hype cycle right now. And I know, as I put my CFA financial hat on, and I'm like, I think everything's going to get overbought, and I need to take a broad aperture here of boring B2B SaaS companies, basically.
You're solving real problems. And I find those founders are coming from a place where they've either lived it, they felt it. It's like they know that industry, they know the pain points, and creating a solution. it's not just capitalizing on a point in time. It's fundamentally strong business.
No, they fundamentally they see a problem and they come from that industry, and it's kind of boring. And maybe it's a 500 million or $1 billion outcome you've never heard of,
Yeah.
but it's still a great outcome if you get in at the early stages.
I love it.
And it's kind of boring, and that's what I love about B2B SaaS. There's lots of $1 billion companies you've never heard of, and it's not shiny and it's not sexy, and yeah. Businesses are always going to want to save time and save money, so just figure that out for them. And yeah, what's your preferred asset class? Venture, growth, or buyout?
And
there's something else.
Love equity broadly. I think I'm not a credit. I'm not a downside focused person. So I'd say venture, growth, and buyout are my favorite children. But having spent the last couple of years focused on venture, it really does. I think it pushes your brain to think about what could be. It's one of the only industries where you're creating new companies out of whole cloth rather than like.
Yeah, I think Sam Altman said this in an interview. He's like, try not to think about what could go wrong, but think about what could go right. And if it goes right, how big will it be?
Yeah.
I thought that was like really interesting advice. You're trying to think about like, hey, if everything goes right with this, how big is this company? You know, how big is this vision?
Those mental exercises to actually push yourself to think about that. And I think we used to use an analogy of like, you can think the human mind thinks in a linear way rather than an exponential way. And when you start thinking about exponential growth, it changes everything.
I got my Kurzweil books right behind me. Big fan of Kurzweil.
Very cool.
Biggest career risk you've taken?
I think it's just the moves that I've made, kind of going from a place like MetLife to Allocate, going from a very stable role at a stable business to go join a startup. And then honestly, as Allocate grew, jumping there to start my own thing. So I think those moves, they're calculated. I wouldn't necessarily call them huge risks other than I think the MetLife to Allocate move. But yeah, those kind of jumps. Can't say I knew exactly where I was going, but
they're kind of betting on yourself. I love that. Yeah. What's one piece of advice you'd give to yourself back in the frat club, 20 years ago?
Yes.
Back in your mid-20s.
I think that the one thing, and it's one of the few regrets I have, I'm not a big regrets person, but be flexible and be mobile. I had an opportunity to take a role out in San Diego and with the company and help open an office out there. And I turned it down. It's one of those big regrets. So I think at that age,
you didn't take the risk. You're like, I'm kind of set here. All my friends are here. I'm not going to take a risk. I'm just going to chill.
Exactly. So it's just one of those, there's life happens the way it's supposed to happen. But that's one of those things where if I could go back and whisper in my ear, I'd say, take the move.
Yeah. Take the risk. Yeah. Mm-hmm. Well, I really enjoyed the conversation, Matt. Thanks so much for coming on. Where can people find you online?
Yeah, I'm pretty active on LinkedIn. It's where I post a lot of content, share a lot of insights, and on Twitter as well.
Well, thanks so much for coming on. Appreciate it.
Absolutely, Brian. Thank you.